Terence. I just have to clarify on that point. I'm just the hobby jogger, and Terence here has been running ultramarathons, so I'm just aspiring one day to reach to the sort of levels where Terence already is for many years. Good afternoon and welcome on the session on the branded residencies. It's a very interesting topic. It's a very relevant topic for this region, and we have an outstanding panel today for it. So I'm going to quickly bring them on the stage, and we'll run through some introductions then. So please give it to Jerome, Suma, Jaidev, and Selim. So while they're just getting their seats here, I'll just give just a quick introduction to myself. I run strategic hotel consulting, and we've done a lot of work with branded residencies in Middle East, Europe, Asia, as well as in Africa. So we'll run this session from the point of view of Middle East and what's relevant for this region, but I will also bring in some benchmarks as and when relevant from the other regions. So let's do quick introductions. Suma, if you want to just introduce yourself briefly.
Well, good evening, everybody. I'm Suma Venkatesh, Executive Vice President, Real Estate and Development for Indian Hotels Company Limited. Indian Hotels Company Limited today has 145 hotels, which includes serviced residences across India and also across 11 countries. That's 10 countries besides India. And we, as part of our portfolio, operate across 3 brands, Taj, Vivanta, and Ginger. And we operate 2 luxury residences, one in India under Taj Wellington Mews brand, and also the 51 Buckingham Gate in London. We also have residences as part of our hotel in Cape Town. And we have another service residences in the making, and we should be opening that soon.
Super. Jerome from Marriott.
Good afternoon, Jerome Briet, Regional Vice President for Mixed-Use Development for Marriott. I'll reintroduce Marriott shortly, but roughly it's 6,700 hotels across the world, growing to 370 hotels in Middle East and Africa, with our base in Dubai and a sub-office in Cape Town. I look after the branded residences expansion across Middle East and Africa, which historically has always been accompanied with hotels. And now more recently, we also do standalone branded residences on all our full-service brands, starting from Marriott, Sheraton, all the way up to Ritz-Carlton, St. Regis, and all the other luxury ones.
Great. Selim?
Yeah, hello, everyone. Again, my name is Selim. I represent Deyaar Development PJSC, a Dubai-based developer. We are a developer multidisciplined over many different asset classes, starting from residential to offices. And recently, the company has forayed into the hospitality market. We are hoping to open up probably around 1,000 keys in the next 12 months in Dubai, with another about 1,000 keys as well in the pipeline that we're looking into.
And Jaidev.
Hi, my name is Jaidev Menezes. I head up development at Emaar Hospitality Group. We're a fully owned subsidiary of Emaar Properties. We have 3 hotel brands, Address being luxury, Vida is upscale, and Rove Hotels is our contemporary mid-scale brand. We own and operate 12 at the moment, all in Dubai. We've got about 35 projects that are in development across the region, mostly the Middle East and Africa and Maldives. Of the 35, we're moving more towards management contracts versus owning and operating. We'll continue to own and operate, but we're also looking at growth via management contracts, and a lot of that is coming from Rove at this stage.
Excellent. All right. So let's do a quick sense check with the audience here. Who has experience with branded residencies in the audience? Okay, quite a few. Good experiences? Bad experiences? Okay, not so far too many bad experiences. So I just want to kick off with this point that I think branded residences is one of those asset classes that when it works, it can work extremely well. And when it goes wrong, it can go wrong in a very bad way. So let's just take it to our panel here and see if we have any examples, perhaps, that you have come across where branded residencies didn't work well and what brought some trouble. Maybe Jerome, with Marriott, you've got a lot of experience. Any not so good experiences?
Well, I mean, when we started the branded residences business in the late 90s, essentially, which was really the booming time, we quickly went to a big hurdle in the late 2000s with the crisis. And typically what happens is when the real estate market starts to go south, you will see that all the financed unit owners stop paying service charges. And that is generally the worst thing that can happen to the branded residences. So we typically ask for our developers to stay on the hook and underwrite some of those service charges, which they don't like to do, obviously, or they want a cap on this. But in the US or in Canada, which is really where this model is more established, we have seen a lot of those defaults. And then you're left with only two solutions. You try to foreclose on the property and sell it, which is a long and painful process, or you walk away as a brand. And typically that leads to a multitude of owners who continue to pay their service charges, trying to sue the developer to recover for the potential loss with the brands leaving the building.
Yeah, okay, so that's a good example of the sort of troubles you need to watch out from the point of view of an operator also. So just on that topic, Suma, I'd be interested to ask from you, you have been quite cautious with your group in entering into these agreements with branded residencies. How do you see this with the brand integrity? How do you ensure that brand integrity remains for operators?
To start with, we do not do standalone branded residences for sale, or we have not done. And as you rightly said, we are very cautious. The way we have done it is part of a resort or it's part of a hotel. So you have the hotel, you have the developer, as Jerome just said, fully invested and interested in the larger development. When it comes to maintaining brand integrity, the way we see it is in two stages. One is during the development stage itself. How do you ensure that what is built is really built to the standards of, say, a Taj, and to the standards of the hotel that is being branded and managed by us within the same development. We are completely involved, the technical services is involved during the entire design stage, so that what is eventually built as residences goes with the rest of the development. We are also wary when the developer gives complete freedom to the potential buyers to fit it out the way they want and build it internally the way they want, because often then it ends up being like a construction site even when the rest of the hotel or the development is operational. So we try and control all of that in the kind of lay down how things have to be done. The bigger challenge really is to maintain the standards once it is sold and managed by the operator, where you want the owners to pay for the common area maintenance, you want them to invest in maintaining the architecture, the facade, the exterior of the property, so that you don't really have one end of the development which is not going with the rest. And here again, we want the developer to underwrite the charges and the expenses so that we don't have to really end up in dispute with multiple owners that have bought those residences. So we get into those projects where the developer is actually a single point contact and a go-between us and the potential buyers.
Okay, so it goes a little bit back to the point Jerome raised earlier there about the managing the charges situation.
Sorry, Deyaar, just a quick one on that point. I think one of the challenges or a nightmare an operator has in terms of mixed use is being able to, for whatever reason, in a lot of parts of this region, the tenure or the term of the management agreement, the hotel management agreement, and the resi management agreement don't line up, right? So the resi management agreement is governed by local law. The HMA is a commercial structure. So you have a situation where you've got a branded hotel and a branded resi, but the branded resi can be terminated for whatever reason, and an operator can be left in a situation where the brand is up on the building, but they're not in control of operations, which is a nightmare scenario, right? So, and on the flip side, if they get terminated on the hotel for whatever reason, whether they choose to exit or they get terminated, again, you're potentially left with the brand on the residential. So the way the legal structure and the way that's set up in terms of sale purchase agreements and all that is absolutely critical.
But surely you'll make them coterminous, right?
Yeah.
If the hotel gets terminated, you don't want to stay there in the
Correct.
residence.
So cross-termination, yes. But then the challenge is sometimes, like Dubai, they have a 3-year cycle for branding, right? So the HOA or the owner association, which is non-existent, can terminate, and then you're stuck with you potentially get stuck if the agreements aren't structured right.
Yeah.
I think if I may as well, JD, what he's pointed out is very much true. You need to structure the agreements when you first start out. So obviously we at Deyaar, what we have is a structure where we would keep most of our residences or service apartments, and we would sell another portion of it. However, we would retain the majority, hence we would retain as well the majority vote within the agreements. So nobody would be able to terminate the hotel operator without our say-so. And that is very important and critical that you get it right from the start.
We need to talk after the panel.
Yeah. So getting the contracts right from the start, that's one good takeaway. I want to change a little bit the style now, and we're going to run a few rounds of so-called rapid-fire questions. So what that means is that I'm going to give a few questions to the panel, short and sweet, and I'm expecting to get a one-word answer only. So if you don't like the question, just pass, but we're going to go through a couple of rounds on a very fast pace. First one, we'll run through this way. So when it comes to branded residencies, urban, resort, or mixed use, what works the best? One word.
Resorts.
Mixed use.
I would agree with Jerome, mixed use.
Urban mixed use.
Okay. Mixed use, clear winner. You want to do branded residencies, mixed use. Next one. Luxury or mid-market?
Luxury.
Definitely luxury.
Mid-market.
Both. I'm with Selim.
Mr. Emaar, we do everything. Rental pool or no rental pool?
We can go the other way.
Okay, we're gonna
I
switch.
can't pass.
Go.
Rental pool, urban rental pool.
I think a rental pool, self-use pool, and our pool as owners. 3 pools.
Yeah.
No, definitely no rental pool, maybe rental program.
Oh, come back to that.
Rental program.
Okay. What is a realistic rental pool return expectation in terms of percentages within Middle East context?
So in terms of the pool, so if $100 comes in, $50 comes out. So it's about 50%, 45 to 50 in terms of rental revenue.
Okay. But annual return
yield?
percentage of yield.
In terms of yield for straight resi for here in Dubai, 4 to 6% for say AAA, and then theoretically for branded resi and a successful rental pool should be a couple of points higher, net of service charge, somewhere there.
I'd go back to what I said before. The reason why I like mid-scale or not luxury branded residences is because they give a sharper yield, a better yield for the investor.
Number?
So I would say maybe around anywhere between 6 to 7.
Okay. Jerome?
Yeah, marginally higher than their normal residential. So I'd align with Jaidev, probably around 5-6%.
Yeah.
Yeah, I think it should be marginally higher than your normal residences. Yeah.
So this is an interesting point just to maybe bring it into global context here. We've done a lot of benchmarking analysis when it comes to the rental pool programs. Any guesses from the audience? What's the global benchmark for annual yields on the rental pool? It's between 2 and 3%. So it's not a lot, and that's one of these things where there is a bit of a mismatch between expectation and reality. Having said that, Middle East so far has been the one market that has outperformed almost everything, perhaps with the exception of Asia in some markets. So I think you are guys actually not too far off what's possible to achieve in Middle East, but that's not a realistic number on a global context. Back to rapid fire. Guarantees or no guarantees?
HMA guarantees or no guarantees ever? As an operator, no guarantees. Even as a developer, no guarantees.
We would definitely go for guarantees, depending on the market cycle.
I don't think I need to answer that. I'm an operator. There is no guarantee.
No guarantees.
Okay, but so Selim has a different view on that. We might come back on that. Brand premiums. Is this worth paying?
I think start with Selim on this one.
Brand premiums. I mean, this is a story which we can stay here for hours. I think if you select your brand correctly, and you match the brand to the bricks and mortar you're trying to build, and you assess what this brand is actually bringing in terms of name and clientele, then yes, sometimes that is a big positive for the development. Yes, absolutely.
So yes, okay, Jerome.
But there's a huge amount of services that can be offered, right? So if you're buying into a Ritz-Carlton residence, a St. Regis residence, the quality of lifestyle that you get in there is non-comparable to any other luxury residential. You can go away, come back to your country, give us a call, we'll fill in your fridge, we'll clean your car, we'll walk your dog, we'll do everything you want, so that by the time you come, you're actually home and you've got nothing to do. So that, for the high net worth individual, is worth every single cent.
So yes, so yes.
Yeah, I would agree with Jerome that a luxury brand operator really brings huge value, and there is a certain degree of lifestyle and trust that you will be taken care of, right? So if it's your second home or a vacation home, for sure there is huge premium.
Okay. Again, just to bring it into global context here, so you're looking brand premiums, anything, or let's say royalty fees for the brands, anywhere between 1% to almost to 10%. And in terms of the actual premiums that are achieved with the top luxury brands, you're looking 20-25%. So I think the answer is right there. Now comes a tough one. We're going to start with Selim there. Who is the best player in terms of branded residencies and developer within the Middle East?
Tough question. Without naming names, I think.
Oh, it's a name.
I think there's a lot of good operators in the region. There's a lot of examples. If you look at the Palm, for example, there's plenty of evidence there of good projects that have gone up with good operators that have sold as well branded residences right next to them. So developers, there are some very good developers as well, including ourselves, that are able to execute, and that's the key, ability to execute in this market and bring to the market the offer that you have actually promised your customers.
Okay. Jerome, any specific name you want to highlight?
So the question was the best player?
In terms of the developer of branded residencies in the Middle East.
So the real estate developer?
Correct.
But I would probably say Emaar.
Yeah, that's kind. Suma?
I didn't say they were the best branded residents.
Yeah, so we'll come to that.
I'm not really sure. I'm sure there are quite a few good developers in this region, and eventually it is a combination of both the right brand that goes on to the development. So it has to be both. I don't think you can just have best developer irrespective of the best operator to run it.
Do we need to ask from you, Jaidev?
No, I think Jerome is right. I mean, branded resi 10, 15 years ago was completely nascent, right? I mean, on the Palm, I think someone mentioned there's been a number of good developers who sold and built through the crisis and then delivered both the resi and then, more importantly, the hotel in a lot of cases, right? So I think, and the law is also catching up, right? So the legal piece is still behind in terms of the structure, and it's a challenge for operators because it's extremely consumer friendly, which is great, but it's also, from a branded resi operator perspective, there's a big gap.
Okay. And last question on the rapid fire style. With Jerome, we start with you on this one. So, best operator, Middle East context, branded residencies.
Well, it's Marriott.
Fair enough.
I think yet to come, the Taj.
Okay. Jaidev?
I think we do. I think we do a very good job at Emaar Hospitality. I think we have more branded branded residences than we do actual hotel keys in Dubai. And I think, given location on a number of projects, we've delivered, we maintain quality, and we operate successful rental pool structures as well.
And if you have to pick one of your brands, Address.
I think Address has done probably the best job, but we're also looking at Rove.
Yeah. All right. And Selim, your
In
sort
terms of best operator for branded residences, if we were to do a brand residence, and probably we won't at the moment, I would see Kempinski being one of the front contenders in this, purely because of premium that we can get as a developer.
Yeah. All right. Jaidev, I want to ask from you next about this move more towards the mid-market segment. So Emaar has a long history of doing branded residencies in the region with Address, Vida, now we've got Rove coming. What's your view in terms of this move towards mid-market? Is this now the new trend? Is this something that actually works better than the luxury?
Well, I think, I mean, as if I put our operator hat on and we're looking at it as a hotel operator, I think clearly the mid-market segment we all know is underserved, and there's a big opportunity, hence Rove, at least for us, and we're aggressively looking at rolling out in Dubai and the region. I think the branded residential piece adds some value to the developer when it comes to funding and financing early stages of the project. We have recently announced a mixed-use Rove, which is our first mixed-use Rove, actually. So it'll be interesting to see how it works. But we were talking about premiums earlier on the residential, on the luxury side, which is probably 20 to 40, somewhere there. On the mid-scale, it's probably going to be a slight bump in terms of premium, just given the fact that it's furnished, given the fact that there's smaller units, therefore lower ticket size, and therefore more investor-driven, and therefore rental pooling, right? So with the mid-scale option, I think it's critical to have a strong, to keep the hotel relatively small. You'll get a certain, a high level of participation from the residences taking part in a pool. So as an operator, we're operating both the hotel and the residences, the rental pool. And being able to manage both will be interesting.
Okay. Jerome, you mentioned earlier about this, you would prefer to run a rental program rather than a rental pool. Can you just elaborate on that? What's the difference?
Right. So just to be clear, ideally we run none of them, right? That's the ideal situation where we've got a branded residence, which is an actual residential product as opposed to a hotel product or a rental program. Now, the big difference between the two is a rental pool consists of taking the entire revenue from all the individual units, pulling it together into one P&L, and based on what's left, you distribute the dividends. Now, that looks a heck of a lot like a securities, and we don't like that. We're an American company, we're listed on the NASDAQ. Ideally, we don't get associated with the sale of the securities, right? We've got our stocks, and that's just good enough. The rental program, and sorry, there's another big difference. The rental program consists of taking any revenue from a specific unit, putting it together in one P&L, so one unit has its own P&L, and based on the revenue that you generate, you will agree up front in a management agreement with the individual unit owners of a percentage that will actually be given back to the unit owner, typically around 40-ish%. The rest going either to the hotel if it's a mixed-use development or used to pay cost. The reason why that's better, it's because it's hard enough for hotel operators to have discussions on budgets, to have discussions on actual bottom line with educated hotel owners. It's very difficult, and it's a healthy discussion. Try to have it with a unit owner that has never got into a hotel P&L. That is a recipe for disaster. We don't like it, so we stay away. If we have to do it, we'll look into it, but it gets very challenging. And we've had a few of those in the US, where the market is arguably ahead of here on the legal system, so we're slightly more protected, but we don't like it. We stay away from it if we can, because as an individual unit owner, it's just as good. I mean, they won't make the difference. If you tell them you will make X, and X is a variable based on the revenue of the unit, and we have the softwares internally that will rotate the units on a fair and equitable basis to ensure that there is no possibility for an individual unit owner to say that his unit was not rented as often as the others. We've got all of that in place. We've got an agreement in place. It's a very clear cut. You're getting a percentage of the bottom line. But again, that should be only in very specific market. You will typically see that those kind of products are asked for developers who are in very remote locations or very seasonal markets to help finance the hotel. And all I can say is based on experience, and we've got about 100 of those residencies across the world in very, very different markets. These programs work well in city centers of key cities. So you want to do it in Dubai, you want to do it in Miami or in Riyadh, there's a discussion to have here. But if you want to do it in Zanzibar, which is a very seasonal market, or in Marrakesh, which is a very seasonal market, don't forget that your unit buyer will want to stay there during the peak season. And during the off-season, when your hotel is already suffering from an inventory that can be filled in by the operator, you now have another 100 or 150 units that compete with your hotel, and that shrinks your margin. So it's very important to keep that in mind as you're thinking rental programs. Only do it in the markets that make sense.
Yep. And I'd highlight in general, the season, when it comes to seasonality, that's another red flag to watch when you're doing branded residencies. Not to avoid, but just to be careful.
Not branded residencies, rental pools. Branded residencies are always a good, good option.
So Selim, I want to talk to you a little bit about the, let's say, future investment models of this asset class. So there's a lot of discussion now on things like crowdfunding. We had a session yesterday, blockchain and so forth. How do you see the future investment models in relation to branded residencies?
Yeah, I mean, for us as a developer, our core business is to sell the bricks and mortars. This is what we started out with in Deyaar. And obviously everything that comes into market, everything that's new and innovative, we also look at. One of the ways that we look at into diversifying our ability to sell units, whether it was residential or service apartment or anything else, is to see how we can offer this to the market in a different way. For example, the branded residences or the service apartments on a strata business model or a condo business model, which is a rental pool program. This is a way for us as well to diversify our offering to the market. And obviously with the crowdfunding coming into Dubai, in addition to perhaps later on blockchain, as you know, Dubai Land Department has also taken some initiative in that perspective. We see these as also alternative channels that perhaps in the future we can tap into. Again, if you look at crowdfunding, it looks a bit like the fracture ownership business model, or not the timeshare, but the fractured ownership business model. So we see the market here slowly developing in terms of how we can offer real estate in its various modes to the market. Again, crowdfunding is coming into the foray. So now somebody who has maybe 5,000 or 10,000 dirhams can invest into a service apartment that usually would cost millions, and they will still be able to get some kind of a revenue coming back. This model is, I think, yesterday, as the gentleman was saying, in Smart Crowd, it's coming to the residential market, first of all, in Dubai. So we look into this as a way, again, to diversify our offering into the market, and we hope that the future would also include hospitality.
Excellent. Let's just open up to the audience at this point. Does anyone have questions on this topic to our great panel here? How are we doing on time in general? We're still got 2 more minutes. Yeah, okay. Well, if no one has questions,
I would like to add something that Jerome was saying, talking about before on the rental program or rental pool. I agree in some aspects of it, but look at it as well from a developer perspective. Obviously, a developer would love to be able to sell his units to the various segments within the market. As Jerome was saying, it's a way for us to be able to recoup our investments much faster. As a publicly listed company as well, we're able to recoup these investments and to put them on our books. So it's important for us as well to have a rental pool program, and not a rental program as such, because we see the type of clientele that buys those type of units are very much on the higher end of the spectrum, which they would like, for example, to stay in these units maybe 1 month or 2 months. So they're a bit different than what we are targeting as a company, which is mostly focusing on the 2-week, let's say, frame, where an investor can stay in that unit and then he has to exit it. So we see these more applicable to the higher end of the market, the branded residences, rather than the condo business model or the strata business model.
Okay, all right. I think we'll wrap up here. We'll would like to thank the panel for your excellent input today, and thank you, audience. And we'll bring it back to Terence, the ultra runner.